Hi everyone. So I'm going to explain an example that shows how lack of access to financial markets can prevent individuals from investing in positive NPV projects. So in my last video, we went over two different investment opportunities, and I showed to you that how by using future value, the concept of future value and the concept of present value, we can determine which investment opportunity is the best choice or option. I just review two investment opportunities that we consider. In the first investment opportunity, which is investment in an ice cream shop, you initially invest $1,000, and after 1 year you will receive $1,200 in cash flow. And in the second investment opportunity, you can invest any amount of money that you want, and after 1 year you will receive not only the principal amount of your investment, but also you will receive 10% interest rate. And all the calculations that we did in the last video showed that the first investment opportunity is the best investment opportunity or best choice. Now, let's consider an individual that has initial fund of $1,000 at time zero, but he has to pay for his consumption today for amount of $546, and his tomorrow's consumption is $600. So, although the individual knows that first investment opportunity is better than the second one, he encounters a problem because for investing in the ice cream shop, he should invest $1,000 today. But today, he has to pay for his own consumption too. So he cannot invest in the first investment opportunity or in the ice cream shop. So let's consider the second option. Assume that the investor or the individual decides to invest in the second investment opportunity. In this case, at time zero, first the investor pays for his consumption, which is $546. And then whatever that is remained, $1,000 minus $546 will give you $454. So he will have $454 in cash at time zero. He goes and he invests this amount at 10% interest rate. So this is another cash outflow at time zero. After one period, the investor receives not only the initial amount that he invested, but also he will receive 10% interest on the amount that he invested, and he will approximately get $500. But as you can see, in time period 1, his consumption is going to be $600. So this second investment opportunity is not a good choice for the individual or for the investor. This is where we can see what's the role of financial markets. It is better for the individual to invest, right, in the first investment opportunity because it has higher return and it has higher net present value. In order to do so, he cannot do it alone because he only has $1,000 today. This is where we can see the role of financial markets. Assume that this investor has access to financial markets and assume that he can borrow at 10% interest rate. In that case, what would he do? So first of all, at time 0, he goes and he invests $1,000 in the ice cream shop. But now he should pay for his consumption today. In order to do so, he goes and he borrows $546 from a bank at 10% interest rate, and that's a cash inflow. And he will use that cash inflow to pay for his consumption, which is a cash outflow. After one period, what happens? The investment from ice cream shop will provide him with $1,200, and what he has to pay back his debt. So he has to pay not only $546, but also the 10% interest on this amount. So he will have to pay $600 to pay back his debt. So we have a cash outflow at time 1 for paying back his debt. And as you remember, he had a cash outflow for his consumption at time 1. So now you can see that the amount of cash inflow at time 1, $1,200, is equal to the sum of cash outflows at time 1. So in this example, you can see how access to financial markets can enable an individual to invest in a project that otherwise he would have to forego. Thank you.